Good morning from paradise. My name is Crypto Amaru. It is Tuesday, March 18th, and we are back with another daily rundown brought to you by Crypto Paradise, the only channel giving away 3 free nights to paradise. Hit us up. Let's hang out on the beach. Life's too short, guys. We also have the Surf token launching soon, the mini app, and a lot more going on. We're cooking a lot in the background, news, events. We are growing this puppy and very happy to have you along with us on the journey. All right, so what do we do in the daily rundown? We talk about the most important news stories of the day that are circulating and permeating within the crypto space, and we unpack them for you. We analyze, we evaluate them for you so you can hopefully walk away a little bit smarter, a little bit more informed, make some better decisions, make more money, right? That's the name of the game. So what are we talking about today? We are all about the Fed. Fed. It's the FOMC, Federal Open Market Committee meeting is today. As we speak, the Fed chairperson and the other members of that committee are sitting down and they are determining the direction of the economy and the financial markets and interest rates. And what they do is probably the most impactful thing as respects the crypto market outside of probably what Trump does with tariffs. So this is the name of the game. This is what we talk about on this channel all the time because it impacts the prices probably more than anything else. Before we get into what I think they're going to say in the meeting, and this video today is going to be about why I think they're likely going to be making mistakes tomorrow and going forward. But let's just back up. What does the Fed do? Let's explain that real quick. So Federal Reserve, it's an independent body of the United States federal government. Their job is to set the economic policy of the country, and their dual mandate is to have low inflation, which they define as no more than 2% price increases year over year, 2% annual inflation rate, and at the same time maintaining full employment. So that's their goal. They're trying to find that sweet spot of low inflation, full employment. Not an easy thing to do, and we obviously know we just went through a big bout of inflation after COVID hit and the stimulus came out. We ran to 9% inflation. The Fed had to jack up interest rates to like over 5%. And we were in that very, very high interest rate environment for about 2 years. And then at the end of last year, they started cutting rates. They had 2 jumbo cuts, right? 2 a half a percentage point cuts towards the end of last year. And now we're sitting at about 4.25% interest rate. And the question now on everyone's mind is, what does the Fed do next? Are they going to cut rates, increase them, stand pat? And then what are they going to say in tomorrow's press conference? This stuff is incredibly important for you guys to understand if you're in the crypto markets, because there's probably no other person or entity out there, outside of maybe Trump, who can impact the markets as much. We know risk assets, and that's what crypto is, for better or worse, it's a risk asset, is very sensitive to sort of the monetary policy. Is it in quantitative easing stance, or is it quantitative tightening? When it's tightening, people are fleeing out of risk assets and they're investing in less risky things like certificates of deposits or maybe gold. Gold's doing well for other reasons right now. But when it's a loose policy, easy money, that's when people feel comfortable and they're seeing better returns and they're going into the risky assets. So this is the name of the game. I mean, there's really no more important thing to look at than the Fed policy if you care about the prices of Bitcoin and cryptocurrencies. So, all right, what do I think is going to happen tomorrow? Well, I think they're going to stand pat. And everyone's saying this. This is not just really like, I'm not going out on a limb here. Oh my God, what a crazy take. It's, most market participants are saying they're going to keep the fund rate as what it is. They're not going to increase it. That would make sense, but they're not going to lower it yet either. I think that's a mistake, and I'll explain why in a second. But then the other thing is, what is Powell going to say tomorrow? I mean, I think he's got to give some reassurance to the market here. I think he's got to acknowledge that the economy is under pressure and under stress right now, and that they're more focused on that mandate of full employment than they are worried about inflation. If he says that, if he says, we care more about employment right now, we're seeing weakenings, and here's why, we're not going to cut the rates yet, but we're looking at this, and, we're looking at 2 or 3 cuts this year in all likelihood, based on how we view the economy, blah, blah, blah. If he says essentially, he's never really speaks in those clear or stark of terms, but if that's what how we read the tea leaves, so to speak, and he comes out and says that, I think we're in great shape. Hey, quantitative easing is coming back at some point this year. I know it's not right now, but hey, maybe in the May meeting, we get a cut because Powell's coming out very dovish. That would be amazing. I don't know if he does that. But he absolutely should. I think they should actually cut the rates here. And they should come out dovish. And here's why. Look, I understand that they're concerned about tariffs and the potential inflationary impact of those tariffs. I understand that they saw the January reading on the CPI and the other inflation data that they look at, PPE, I believe it's called, and they saw that it was a little bit higher than they expected. I get that, but February came in lower than expectations, right? That's one thing on the inflation side. So it came in less than we expected. But I think you've got to get a lot more granular than that. You can't just look at these general things and say, okay, well, I guess it's a wash and we're a little bit worried about inflation coming back, so that's it. No, there's a lot of issues going on with the American economy. And, I mean, I would imagine the Fed has access to this information. I'm getting it on my newsfeed. You think an army, there's probably thousands of people working at the Fed, think they know this stuff. But I want to highlight a handful of news stories that have jumped out at me, which demonstrate that the American economy is under a lot of pressure right now. And then we can talk about some other thoughts I have on this topic. But so kind of you're doom scrolling through, and the tariff wars obviously taking up a lot of mind share. And I get it. There is a concern that these tariffs, if not done strategically, and we'll know on April 2nd. I mean, I'm a little scared about April 2nd. We'll talk on that in another video. But Trump's going to make a decision on the Mexico and Canada tariffs, I believe, on April 2nd. So we'll see what happens. But if you read some of these more subtle stories, you start to see cracks in the economy. There was one that popped up on my feed today. At first glance, you're like, oh, that's weird, whatever. But it turns out that Americans are now spending less on chips, snacks, and sodas than they have in the past few years. And you saw Pepsi's stock price take a dip, and other manufacturer companies within that sector, their stocks are down as well. And why is that? It's not that all of a sudden Americans decided to become healthy. It's because they feel they can't afford snacks, chips, soda, and they're cutting that out because it's not like essential to them. That's a scary thing. Like, wait, people are so worried that they're cutting out their snacking? This thing costs a couple dollars and they're worried about they're cutting it out? Not a great sign. Here's another bad sign. Flights. Americans are spending less money and they're going on less flights. Huh. Why is that? Well, could it be that people are a little spooked? They don't really know what's going on with these tariffs. They're a little bit worried about where the economy is going. And so they're taking less trips. Maybe they're opting for a road trip instead. Right? So Americans are taking less flights, right, all of a sudden, out of the blue. Right? And here's a big thing. I don't think enough people are talking about this. We know that the American economy is powered primarily by consumers. It's a consumer economy. Well, who spends the money? Who spends the bulk of that money? Well, it turns out that 10% of Americans, the wealthy Americans, defined by people who make $250,000 or more every year, they are accounting for 50% of the spending every year. So 10% of people, 50% of the spending. Well, those people also own stocks, right? They own real estate. They're investors as well. And when you take your portfolio And within a month, it is 10% down if you're in a diversified, S&P 500 sort of ETF. Or God forbid you were holding on to Tesla and that's given up all of its gains since November. You are feeling poorer. And when you're feeling poorer, you spend less. And so I think these stories about the flights and the snacks and the fact that the consumer that powers this economy is all of a sudden feeling much more poor and a lot more scared and a lot more uncertain than they were a month ago. This is going to trickle into the real economy. They say that the financial markets and the economy are different. And yes, they are technically different. But they're interconnected. They're related. And so when you have people who otherwise, they're doing well, things are going great, Trump trade, we're all up, and then bam, a lot of uncertainty, a lot of fear, and the value of your portfolio or retirement accounts are down bigger and faster than you probably envisioned. You are not going to spend as much. And when people don't spend as much, that does affect the real economy. So this is the stuff the Fed needs to look at. They're just looking at the data. That data's old data. The data they look at is always at least 30 days old. They need to be reading the news stories of now. And I'm sure that they are. But, the fact of the matter is employment and recession and growth concerns are much more of an issue than inflation all of a sudden coming back out of the blue. It belies logic that we would be under this high interest rate regime going on now for 2 years. Probably their target rate is like 3%, something like that. So they're well above their target rate. They should want to get it down. It's been high. It's been weighing on the economy. Mortgages are like 6.5%. It would make zero sense to me that all of a sudden tariffs, which didn't actually happen yet, are going to take us from low inflation, and inflation that's been trending down under the weight of these high rates and all the uncertainty that's going on, and then all of a sudden we shoot back up and oh my God, it's inflation time again. No. That's not the risk, Chairman Powell. The risk is that all this chaos and the tariff wars and the stock market taking a massive crash are scaring consumers and causing them to buy less stuff. And when we buy less stuff, the economy slows down. It's pretty simple, right? You think of it in your own experience. Hell, I was planning on upgrading. I was going to get a new car beginning of this year. I was feeling great, Okay, kind of an old car, need to upgrade it, need to get a bigger one, right? So talking to the dealer, this and that, waiting for the right time. I was going through that process, And then all of a sudden my portfolio blows up and there's so much uncertainty and chaos around. I'm not buying a new car right now. Hell no. You have to be nuts. So what does that mean for the guy who was going to sell me the car? Well, he didn't make the commission anymore, right? And so he can't buy his wife a new pair of shoes or take her out to dinner, celebratory dinner anymore. You see the trickle effect of when people stop spending money because they're scared or they feel poorer. This impacts the real economy. So Powell, you got to wake up, man. This is real. There is a real risk that because of everything going on, we massively decelerate from a growth standpoint, and that this impacts the labor market. The other thing that's impacting the labor market, which hasn't showed up in the data yet, are the Doge cuts, right? Elon Musk and when he's doing federal government. And look, we all probably agree that the federal government was bloated and had too many people working in it and was wasting money and all that. But when you fire 30,000 people in 2 months' time, that is going to also have a major impact on the labor market because now you have a lot more people on unemployment. People looking for jobs. Well, guess what? It's hard to find a job right now because the economy's not that good. So I'm quite worried that the Fed is overly concerned about inflation when really they got to be keeping their eye on this economy and this labor market. So my hope is that he comes out and says, all right, we're standing pat. We're not going to cut the rates now because we don't know what's happening with the tariffs and we don't have enough data to go on. By the way, I think that's a mistake, but he's probably going to do that. But he's got to go out there and say something about, we recognize that this economy is under pressure. We see the data on this, that, the other thing in real time. We know what's happening with the Doge cuts. We're expecting that to impact the unemployment situation. And so our chief concern right now is actually we're moving back to caring more about the labor market. If he says that, I think the markets respond very positively. We start trending up because, okay, great, we're on a path towards quantitative easing. The Fed gets it. Economy's under pressure. They need to lower these damn rates. They've been high for way too long, and that's going to be great for risk assets. The final thing I'll leave you guys with, the federal government should want to, and they do want, lower rates because that will allow them to refinance the debt at a lower interest rate. So this is in the benefit of everybody to lower these rates. I don't think inflation's an issue. I think labor concerns are much more salient at the moment. And the federal government, it's in their benefit to cut the rates. They want to cut the rates. They're above their target right now. So, everything is just pointing to me and screaming, cut these damn rates. Or at least signal that you're going to do it. Because that's what we need right now. I'm very worried about this economy, if I'm being honest. And if they don't get their heads out of their butts, we could be in real trouble here. So we'll see how things play out. We'll see my prediction. I'm going to watch this video back tomorrow after he speaks and see how much I got right and what wrong. It's always a fun game to play. But, look, long-term, guys, I always like leaving on a high note. Long-term, crypto, digital assets, Bitcoin, etc., they are on a long-term uptrend, just like stocks are on a long-term uptrend, right? If you zoom out and you're looking at a multi-year sort of perspective, frankly, what happens tomorrow, the volatility and so on, probably matters less. And so that should be your perspective. But at the end of the day, these things do matter too, right? Fed policy does matter tremendously. So let's hope they get it right. Powell, if you're listening, bud, cut the damn rates. And until next time, guys, we'll see you on the beach.